Hello everybody and welcome to my first video. Today I'm going to be going through some budgeting, some finance, and some investing that I do with my money and that I think you should do with yours. Disclaimer, this is not legal financial advice. This is for educational purposes. While these strategies have worked for me, are generally safe, and are approved by many others, it may not be the best for your situation. In this video, I'll be very transparent about the money that I receive from work and what I do with that money to prepare me for an early retirement, a successful future, and in addition to Neighborhood Digital LLC, some other side hustles and income sources that I can use to fund and achieve my dream of GT rate. Very first basic thing, it seems rudimentary, and that is a budget. I'm noticing my webcam is kind of obstructing some of this, so I'm going to go ahead and move that. Whoa, look at that. There we go. Out of the way. So here's my very simple budget. I am a college student, and currently it's the summer, so I'm living at home. I am fortunate enough to not have to pay for rent, food, utilities, that sort of thing. So my budget sheet is very small. But if you remember the book that I was talking about in my introduction to the channel, Millionaire Next Door, very heavily talks about this, especially for people who have a family, who have more expenditures in their house. You can lose track of things. So keeping a very simple budget sheet just to know where all your money is going is very beneficial. Now, this leads me into my next topic. Credit cards and debit cards, what they are and how to use. So a debit card is just a card that your bank will issue you, which many of you probably have, all of you should, unless you're like, I don't know, like 10 or something. What? But it's basically a card that gives you access to the money in your bank that you know that you have. So you can't you can't draw more from that than you have. I mean, you can, it'll just result in a negative balance and you might get charged fees depending on your bank, but that's kind of out of the question. So that's what you would use on things like this. Monthly subscriptions, bills, stuff that you know you have cash for that you need to pay for. The credit card, on the other hand, can be used a little bit more liberally. That's for stuff like if you're going out to dinner, more spontaneous. You need to pay for the food, or you're driving to work and you need to pay for gas. Like me, who drives just about an hour every day to work. So it's an hour back, so it's 2 hours. So I have no gas. If you pay that back on time at the end of every month, you won't accrue any interest and you'll increase your credit score. This is Experian, where I'm showing you my credit score of 768 is very good, especially for somebody of my age. And it's very achievable for you as well. I got my credit card and you just spend money on there, make sure to pay it back on time. You don't accrue interest, which means you don't have to pay more, and you increase your credit score. So this is calculated using FICO. It's one of the several credit agencies. You can do this for free online by yourself. The government offers you one free test, and then you can pay for subscriptions from other credit agencies. Experian does it for free, so that's a no-brainer. Just get an account with them, and you can see this whenever you want. And this just comes from the credit card. So now when I go to a bank and ask for a loan for a car or for a house, they're more inclined to give me money, and the same goes for investment. Okay, next thing. I got a paycheck from work. I'm going to open it up right now. I will say it is a little embellished because some of this I had saved up before. I only got about $1,600 from work minus the tax. This is what we're working with. So now I'm going to introduce a concept of saving part of your money for investing. So a lot of people will just use all of the money that they have on their needs and then splurge the rest of it on clothes, shoes, other accessories and items. There's something out there called the 50-30-20 rule, I believe. It's something that a lot of successful people use. It's very basic. 50% of your income goes to your needs. Your house payments, your rent, your utilities, your food is all under the needs section. You then save 30% for wants, and the other 20% is for saving, paying off debts, investing, that sort of thing. Now, personally, I like to modify that, and you can modify it in your own way as you see fit, but I would say about 50 to 60%, probably toward the 50%, is good for my needs. Currently, I don't have a lot of needs, but when I get to the point when I do have more needs and amenities and a house and things like that, 50% will be for needs. You want to try to live as much below your means as possible here. And then you have a whole other 50% to work with. I would take probably 40% of that and invest it. All of that into an account, which we'll talk about later, so that I can continue to grow over time. And then the other 10%, or maybe I would do 30 and 20, something along those lines. The other 20%, I would then save and just keep that as money for myself, stuff that I can use for my credit card on expenditures or whatever that comes down. So for me at this point in my life, I showed you my budget sheet. There's not a lot that I'm really putting my money into. So I have a very aggressive split modification of the 50-30-20 rule. I do 80-5-5-5. So 80% of what I make goes strictly to invest. Then I take 5% and I put it into crypto. I take another 5% and I save it for myself during the summer, credit card purchases, things like that, food, gas. And then the other 5% I save for. I recommend if you're in a similar position to myself where you're either living at home or at school and you're working a job and you're making a decent amount of money, I would suggest putting as much as you can and as you want into investing. Now that we've got the split ironed out, I'm going to go into what I invest. I would suggest putting money in Robinhood. This is personally where I do my crypto investing, but this is kind of where I have more of my risky stuff, where I do crypto stuff that's more volatile. However, if you're just looking to get into investing for the first time, I would highly recommend this because Robinhood doesn't just do crypto. They do a bunch of other stocks as well. You can get Apple on here. You can get Microsoft. Here you go. Apple. I'm sure we have Alphabet, which is Google. Yep, Alphabet. There's A and C. We don't have to worry about that. Those are just two different classes of it. So there's a whole bunch of great opportunities on Robinhood where you can literally just very easily deposit funds, which I'm going to do in a minute, and put it in without a problem. And you can just leave it in your account, forget about it. I would suggest deleting the app on your phone and only doing it online so you're not checking constantly. And it just sits there and grows over time. Now, if you want to get a little bit more sophisticated, you can go within a Merrill Lynch account or a Fidelity account, something like that. I will say they are a little bit more conservative. And before I get into the more nitty-gritty of investing, I already gave some of it away, but disclaimer. This is not investing advice, YouTube, okay? This is not investing advice. But it's coming from a good place. I've been doing this for 10 years now, since I was about 12, and I learned from my dad, who is a registered CPA, which is an accountant, and I've basically been watching over his shoulder for the past 10 years as he set me up with my own investing accounts, and he's been retired for almost 10 years now. So he used the stock market to retire early, which is what I'm trying to do as well, plus a little bit more for my goals, which I talked about earlier. But while this isn't strict investing advice, these are general rules that you can follow, and you'll see them reciprocated by, Warren Buffett or, other company leaders, other people who invest in the stock market will tell you the same thing. And the age-old adage is time in the market beats timing the market, which basically means you've heard of crypto trading, even stock trading. A lot of people who follow the market every day and try and, when it hits a high point, they try and sell, and it hits a low point, they try and buy. And generally that advice is good, buy low, sell high, but you don't want to be doing that every day because you're not going to make any money that way. You're going to get taxed ridiculously, and it's just not worth it for your own personal mental health. It's not good. I think it's 2%, maybe even 1% of all day traders are actually successful. So it's not something that's really worth doing. It is much more lucrative and much more simple to just put your money in an account, set it aside, check on it daily, sure, and do some research on the companies that you're investing in, but don't over obsess over it and don't continue to take it out and put it in. Time in the market beats timing the market. So keeping it in the market will appreciate over time much more than it will if you're just trying to make a quick buck of it going up and down. Now I'm going to talk about more conservative investing. Personally, I use Merrill Lynch, and there are 4 key things that I want to talk about. So once you have a good sum of money, or you're putting in 20, 30, 40, 50% a month, whatever it is that works for you, and you have it in your account, you're going to let it sit and grow, but you need to know what specifically to invest in. Now, a good rule of thumb generally, no matter what you invest in, is to diversify. What that means is you want to have companies, you want to have shares in companies that are in different sectors in the market. So you want stuff in energy, you want stuff in oil, you want stuff in technology, you want stuff in healthcare, you want stuff in agriculture. You want to have as wide of a portfolio as possible so that if one of those areas of the market starts to not do too well, you still have the other areas of the market that are probably going to be fine, that are holding up your portfolio so the whole thing doesn't come crashing down. Now, the first thing that you're going to want to invest in out of the 4 is something called a bond. Now, a bond is basically a short or long-term holding that is given by the US government and has a specific value that you will be paid back in X amount of years at X amount of interest. What that means is that it's essentially the safest investment you can make. You put an amount of money in, and the government says, okay, we're going to take this money, and over the next 10 years if it's a short-term bond, 30 years if it's a long-term bond, there are other age ranges, but I'm just being general, we are going to pay you this amount each year. And when the bond reaches maturity, meaning the bond is over, you will have received this amount of money. Bonds are very safe, but the interest rate is typically very low. And the interest rate is, you get, usually they're around 3 to 4%. So if you pay $900 for a bond that matures at $1,000, every year it's only going to go up a small amount. So in the next 2 years, maybe it'll go up $5 or $10. And then the next 2 years after that, it'll go up another 5 or 10 until the 10 to 30 year period is over and you have $1,000. That's the way the bonds work. I have a couple of them in my Merrill Lynch account, but not a lot. Very safe, simple type of investing that is there's very unlikely that anything will go wrong with it. The second thing you're going to want to invest in are ETFs. ETFs are basically just a collection of stocks. Think about the S&P 500. It stands for Standard & Poor's 500. That is the top 500 stocks in the US stock market. So there's actually a share of this. I have it here. I can show you on my account. It is called VOO, Vanguard 500 Index Fund. I currently have 1 share. I plan on investing more once I put my money in. And this 1 share is essentially a small portion of every company in the top 500 companies. So what this means is not only are you getting diversification, which we just talked about, but you're also getting a large variety of stocks that are doing very well. They're the best in the US market, and they're usually pretty good in terms of the rest of the world as well. So ETFs are very beneficial in that way. Now, the next 2 things you're going to want to invest in are a little bit more general. You're going to want to invest in growth stocks and dividend stocks. Growth stocks are stocks like Apple, Microsoft, Nvidia. Think of big companies that do a lot of work and then reinvest in their own companies. Some of them will buy back their own shares. If you ever heard of Elon Musk buying his own shares in Tesla, that's what these big companies do. And so those companies, while they don't pay you a dividend, and by the way, a dividend is just a small percentage of the share that they pay you back every month or every quarter or every year, it depends. But in compensation for the lack of dividend, their stock tends to significantly appreciate over time. Take, for instance, Apple. Apple has made me, let's see, $2,741, and I have 15 shares of it. So Apple is a big gainer, but it doesn't give me any dividend whatsoever. Now, dividend stocks like AGNC here have actually lost me $327, but if you look at the dividends, I forget exactly how much AGNC is. They have a dividend yield of approximately 13.5%. What this means is on every share that you own, and I own 107 shares, you get 12 cents. Annually, that's $1.44. So you're getting that for every share, every month, and then every year. So if you get where I'm going with this, you want to have a balance of both. And it's for more than just having the appreciation and having the dividends. The dividends allow you to have passive income. Now, like I said, I'm not going to get too in depth, but from a tax perspective, you lose a lot less money on dividends than you do on growth stocks. So it's good to have a balance of both. And if you can invest generally in those four things, you really don't have to learn that much. Just do some minimal research about companies that you may like or that you already know about. You will have a solid investing foundation. Anyway, I hope you learned something. I hope that this is something that you can apply to your life that will help you succeed in the future. And I know and I hope that it will continue to pay me dividends throughout the rest of my time and help me to achieve my dreams. Thanks for tuning in. See you next time.